Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Legendary investor Stanley Druckenmiller has said that the best economist he knows is the guts of the stock market. For Mr. Blond, an industry professional who has served in both sell-side and buy-side roles focused on risk management and equity strategy, few statements ring truer. Our discussion explores the framework he has developed through various market cycles, one that evaluates a collection of metrics both across and within markets, ultimately aiming to gain an edge in the probability of future outcomes. In this context, we discuss his role on the buy side at a large long-short fund, where he was charged with helping the chief risk taker to better understand the macro climate and how it might serve as either a headwind or tailwind for fundamental security selection. We review a few key events when the macro and micro diverged. Here, Mr. Blond cites the very low vol period in equity markets during the first 7 months of 2015 that masked important signals at odds with this stability, specifically the ongoing sell-off in crude and a widening of corporate credit spreads. In August of 15, this stability was quickly undone as the VIX ramped to 45 when China quasi-floated its currency. We finish our discussion with his assessment of present-day risk and reward and the interplay between the Fed, rates, inflation, and the relative performance of style factors. In his view, disinflationary forces could re-emerge on the other side and give rise to a new cycle in which benign Fed policy and low rates again support the growth stocks that worked well during the prior cycle. Before that, however, investors will need to contend with the potential that financial conditions need to tighten a good deal further. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Mr. Blond. My guest today on the Alpha Exchange is Mr. Blond, a gentleman with lots of experience across both the buy side and the sell side, and more recently, making a really interesting impact both through Twitter and through a very widely followed Substack in which he's sharing his views on global macro, the profit cycle, and how to position in these very interesting times in markets. Mr. Blond, it's great to have you on the podcast.
It's great, Dean. I'm really excited to be here with you. Thanks.
Well, we'll have a lot to talk about here. You've, as I mentioned, made a real impact with developing a following on Twitter and through your writing, and there's some really differentiated framework there that you're using to assess the profit cycle, to sort of think through what's potentially coming next and how to position portfolios. So we'll definitely spend a lot of time on your framework. Before we do that, let's look backward a little bit and talk about your early days in the industry, how you got started in your career. And as we do that, let's just try to uncover how you arrived at this framework for assessing markets and opportunities. So tell us how you got started in the business of finance.
Sure. Yeah. No, it's a great question and certainly can establish some of the foundation for the framework. I took the less traveled path. I didn't start at an analyst program at a sell-side firm. I actually started at the time, which was a small investment software firm called FactSet. When I was there, was a few hundred employees and obviously, larger today. I think if I look back at that starting point, in hindsight, that was really kind of the foundation for building kind of strong skills in databasing, data aggregation, and data manipulation, all of which, I think have increasingly served to be pretty important, obviously parts of my framework, but also how markets have evolved over the last, 10 to 15 years. Not to go, through each one in detail, but, after a few years at FactSet, I entered sort of the street, in another sort of somewhat less traditional way in that, I worked in a private client division of a boutique investment bank where I was helping ultra high net worth and small to medium-sized institutions develop their multi-asset portfolio. And, I think relative to some of the other, kind of standards, stock, bond, cash, type portfolio construction, at the time, we were much more tactical in our approach. But, that really, I think, built on the FactSet experience in using data in creative ways to think across markets, right? So now all of a sudden you're thinking about portfolio construction and the interaction of different asset classes and how that can build for lack of a better term, a robust portfolio, whether that's strategic, and or tactical for the time. From there, I kind of entered the more traditional institutional equity research division of a big bulge bracket firm And that was, on the equity strategy team, kind of moving from a skill set that was a mile wide and inch deep, doing portfolio, asset allocation, portfolios for people. Was the institutional equity research was much more about being an inch wide and a mile deep in a specific, kind of area of expertise. In this case, it was, U.S. equities, which is still pretty broad and obviously allowed me to build upon experience from the previous two areas, but also really, allowed me to be part of a fantastic team of other macro minds, right? Whether it be on U.S. economics, European strategy, credit, rates, foreign exchange, and, vol markets as well. The second portion of my career at the bulge bracket firm was actually on the equity derivatives trading desk. That would have been in early 2008. It was, obviously pretty interesting times that you and I have talked about it at many times before. I think what was most interesting about that part of the career was, it was just a stark reminder that, everything you learn in research and study in research, while it's important, it also is important that it's practical from a trading and risk-taking perspective. And so that was, kind of allowed me to, take the next step. And then from there, moved to the buy side, where I was what I would call, kind of consultant for a fairly large long-short equity hedge fund, helping the primary risk taker think about portfolio construction, what was happening in other parts of markets away from equities, how that would influence the equity portfolio and the core investment philosophy of the firm, and both, thinking opportunistically about areas to play offense as well as defense, and sort of helping the fund put its best foot forward and evaluate markets on a month-to-month basis. The last kind of role before being independent was being a global equity strategist at a very large multi-asset firm. And that was kind of an amalgamation of all the previous career stops, a lot of data-heavy data aggregation and understanding of markets, cross-asset markets, and trying to put equity markets in the context of that multi-asset portfolio, where they fit both in terms of direction as well as what parts of the market make the most sense geographically, sectors, styles, and so forth. So that's a little bit of a long-winded career path, but hopefully gives you a good foundation to an understanding of how things started for me.
Well, when you and I met several years ago, you were in this role where you were helping assist the chief portfolio manager in evaluating the macro climate and kind of overlaying that macro climate and trying to communicate some of the potential implications of that climate on long-short equity. And there are certain equity fundamental managers that certainly I've come across that say, I want to study the stocks, that's my discipline, and I don't want to get distracted by the macro. Others have a more inclusive view and say, look, we've got to pay attention to the macro because sometimes the macro can overwhelm the micro, the stock picking aspect. I'd love for you to just riff on that a little bit in the context of your role there and how you brought to the attention of the team these macro factors that could be relevant but weren't always relevant. What was the balance there for you in terms of looking after macro at a long-short shop?
Yeah, sure. No, this is a great question. And I think, one sort of important distinction I would make up front is I was lucky and fortunate in the sense that the portfolio manager who hired me and sought somebody with my skill set out, already had a pretty high macro IQ and clearly was a believer that macro played an important part in portfolio construction and risk management. It's certainly true that, you can kind of be a bottoms-up fundamental equity investor and you can have a well-balanced long, short portfolio and do well. I think that inevitably what happens is, there's periods of time in the market that can be, to your point, can be overwhelmed by what's happening in the macro environment or sort of external forces. And so a big part of what we did there was really just try to establish a framework. And the framework was built around the business cycle and profit cycle. And in a nutshell, what we were trying to identify was, which parts of the market had what we would call sort of alpha tailwinds and which parts of the market had alpha headwinds. And naturally, we had our own sort of investment philosophy, which tended to be kind of growth momentum in nature. And that's fine. I mean, everybody has a different, way of approaching markets or are attracted to, a certain style of investment. But what's important about that is, again, I guess is, the role was part risk management and obviously also part portfolio strategy. or kind of having that sort of macro fundamental mindset and helping the team to understand what was happening at different parts of the market and ultimately how that would influence the portfolio. And so it was multifaceted. I mean, I think you had to sort of establish a framework. And again, I can't say this enough. I mean, I think how important it is when you're dealing with a number of different people who are approaching the market from different perspectives, meaning you could have a consumer analyst, a tech analyst, an energy analyst, you have a PM who is kind of sitting atop of all those teams, how important it is that the approach is data driven and empirically supported. I mean, in my own experience, what I've found is that that's what resonates with people, and that, they might disagree or they might have a different perspective, or they might say, well, my company said X, Y, and Z, but ultimately, if you can show people in a consistent way and hopefully with sort of reasonably robust statistical evidence, doesn't have to pass the quant PhD test, but it should pass the most sniff test, then I think that usually helps people to understand that the market was more about knowing their companies well, and that there were just periods of time when risk premium was dominated by external factors. So that's a little bit of how we did it.
Well, one of the things that I've seen you do, and we'll talk a lot about it just in terms of present day assessment of risk, but I think what I've seen in your work is you actually uncover that sometimes the macro and micro are not as far apart as you think, that there are relationships that you have tied together. It could be on an absolute basis, but it also could be on a relative basis, whether it's defensives versus cyclicals and tying that to measures of risk premium. I think those are very fascinating and really instructive types of areas of exploration. So I want to talk a little bit more about that. Before we do, I'm just thinking, as this latest round with Italy and now Draghi effectively, his time as prime minister ending, it's just about to the day, the 10-year anniversary of his whatever it takes speech, which nominally might have been in some ways the end of the Eurozone crisis, at least the most acute part of the crisis. But if you go back perhaps 9 months from there, where it's the summer of 2011, if you looked at PE ratios, let's say for the S&P 500 and the subsectors, I just remember some equity fundamental managers, my conversations with them, they could not believe how cheap the market was. Now, my own vantage point of markets is derivatives and risk premium. And I was standing there looking at what I thought was going to be a tidal wave of risk off just because the system was coming undone. The fragility and spreads in the euro itself was, to me, in plain sight. And so this idea of the potential macro tidal wave or tailwind in some cases, can really overwhelm the micro at different points in time. And I was just wondering if over your time period sitting in that seat or the seats you occupied on the buy side in general, what are some of those times where you felt like the macro and micro were at real odds with one another? Are there specific instances you might be able to talk to us about where either the market felt really expensive, but there was some tailwind that people needed to better understand, or the opposite? Perhaps the example I've cited here where the market was really, really cheap, but there was this underlying risk factor that potentially was set to overwhelm that cheapness.
Yeah, I think a couple come to mind from recent history. I mean, obviously, summer 2011, which you mentioned. I mean, that one is not the one that I'm going to talk about. I mean, I think there are elements of that. I think the one thing that sort of quote unquote helped in that scenario, even though it certainly did create some volatility, is that we were still not that far removed from sort of 2008, 2009. So there was still a lot of anxiety from the post GFC period. Obviously, that's part of the reason that valuations were quote unquote low. But there was still a lot of scar tissue that had yet to really be healed from the post GFC. The two that come to mind that are a little bit more recent, one is summer of 2015, and then the other one is early 2018. But in the summer of 2015, that was a period where, well, not to spend too much time elaborating on history, but remember, we had late 2014 where, we kind of saw the break of OPEC, oil prices started to decline, China growth was clearly pretty weak. And then basically for the first, 7 months of 2015, S&P 500 type, equity vol and markets were extremely calm. Even though credit spreads had kind of continued to widen, growth weakness had continued to manifest and show itself. And I remember vividly, and this would have been in late July of 2015, we did a, either weekly or biweekly kind of sit down at the long short hedge fund to just talk about what was happening in markets. And you could see it brewing, right? You started to see a little bit more of the, what I'll call negative divergence between credit spreads and measures of rate vol. That's right, not rate vol, and measures of equity vol. You could see, some of the internals of the market starting to fray. Some of the weaker parts were falling off. But at the index level, things were pretty calm, and it created a lot of frustration because it was difficult to talk about markets in a negative way at a time when they weren't sort of showing they weren't showing much negative momentum. And I remember in late July, sort of saying that the setup and the set of conditions here looks extremely vulnerable in the sense that it's highly unlikely that we're going to have credit spreads continue to widen and equity vol not eventually take notice. And so we talked about that. And then what had ended up happening was we sort of had the what I would call sort of a macro trigger, which kind of unlocked the calmness. In this case, it was China decided to semi-float its currency in mid-August of that year. And I think that was the, it was bigger than a butterfly, but to use a sort of butterfly flap its wings, it was an already fragile situation that just sort of needed, one other thing to knock it off. And then ultimately we had a pretty nasty, sharp 1987 style, kind of correction in markets, not in magnitude, but in its velocity and speed and how quickly things turn, right? Sort of a flash crash. If you remember, then in late 2015, we kind of then had a rally back. Before then, we had another leg lower that was more, fundamental in nature into the first quarter of 2016, and in what was, maybe some would deem a quote unquote sort of soft recession. And there were other factors that were at play too. This was like the Fed was just about to do their first rate hike after, a long extended period of easing. So there were a lot of factors that all kind of came to play. And look, I just remember the first 7 months of 2015, quote unquote, equity markets is a, is a leading indicator or having foresight. Sometimes they don't have as much foresight as people think. So that's one. The other one that comes to mind is January of 2018, which you'll obviously know this event well because it sort of resulted in the short vol blowing up. I mean, my focus there was much more around kind of what was happening in late 2017 and more around rate vol and remember Trump's tax plan and kind of like sort of pushing stimulus in a quote unquote late cycle environment that would sort of result in a swifter move in rate vol that I ultimately felt like would spill over and impact equity valuations. That obviously turned into something much more significant around the short vol trade that was in place at the time. But that was another period of time where you could kind of see something developing in the macro that the broad equity market didn't see or didn't have the foresight to see until it kind of was like on the doorstep. So it does happen, and that's just a function of being kind of aware and, kind of having the same imagination, I think, as well, but trying to have signposts in place that help you to see those divergences. And then like any other, risk framework, it requires, good judgment.
Yeah, there's some similarities in those two episodes. I mean, as I look at just realized volatility for the first 7 or 8 months of 2015, two things are striking. One is it's low, but it's also consistent. It's between 10 and 15 for almost the entirety of the year, with a couple of dips below 10. So I think it's not just it's low but volatile around a low mean. It's low and incredibly range bound. So by August 15th, it's at 11, and then 2 weeks later, it's realizing 45 over 10 days. And so that's a good shock. And I just remember quite a bit of the analysis. And sometimes there's over attribution. The sell side is a publish or perish business. We know that. But some of the analysis that got a lot of credit for calling this was in the area of the vol control type of strategies, because vol was so low and so consistent that vol control vol targeting, these types of things were kind of max long. And so that, when we think about a shock, it's okay, well, what's the import of the news? China is repegging its currency. You said it's quasi floating. Well, that's certainly different. That's important. But then it's also the positioning going into it. And same thing with this VIX event. You're coming off a 50-year low in realized vol in 2017. And that product, XIV, that product suite has gotten gigantic in the process. And just the mechanics of rehedging are not really something that can be accomplished without a dramatic move in price. So those are really good examples. I mentioned the sell side. And so I wanted to just take a little bit of a divergence here and just get a little bit of your perspective, because you've had the opportunity to sit for a period of time, both on the sell side and then also on the buy side. You've almost split your career. And so you've seen both. You've been in the coverage business of trying to get your arms around what clients are trying to accomplish and publishing and sharing insights. And then you've been on the receiving end of that too. And so I was wondering if you could just talk to us a little bit about that, more from the perspective of your time spent on the buy side and having lots and lots of info, charts, pieces, and so forth sent your way. Just share with us some of what it means to do that job on the sell side well. How are people that are successful in offering value accomplishing that? What are they doing differently from maybe the folks that are sending stuff that tends to be a little bit more of the noise from your perspective?
Yeah, I mean, I think the first thing that comes to mind, and I've had these exact conversations with people, is, one is when you go from the sell side seat to the buy side seat. The first thing that was clear to me was like it was like drinking from the fire hose, and there's a flood of information that's coming your way, because it's not just research department, it's also the trading desks, right, and then other aspects of the firm, whether it be prime brokerage or elsewhere. So there is a tremendous amount of information. And as a risk-taking buy-side individual, you have to decide which information, you have to have a good filter, right? Which information is worth paying attention to and which information is not worth it or not worth it right now. And that's not easy to do. Unfortunately, you don't know whether something is worth it or not until you've spent some time with it. I mean, that's just the reality of it. And hopefully you can identify that pretty quickly. But so I would say it's drinking from the fire hose. And the important thing is to drink from the fire hose at the right angle, so you don't get, you don't knock yourself on your butt, right? Because otherwise you can be inundated with data and information, and then you just sort of drown yourself in too much data and too much information. And you spend all your time, reading and digesting, and not any of your time acting. That's one perspective. I think, what does it take to do the sort of the sell side job well? I mean, I'll speak more from a standpoint of kind of publishing research, whether that be, from a trading desk seat as like a desk strategist, or from a strategy, kind of research role. I think ultimately what's useful to the majority of people is a data-driven framework, right? Something that, kind of is a sort of model or indicator oriented that says, this is where I think we are. This is where I think we've been. This is where I think we're going. And with that sort of roadmap in place, or that indicator, kind of based framework, you can also then, I think in a reasonable way, map markets and market returns to those different phases or periods of time, which should give a reader the ability to make their own judgment, right? Like maybe they think that we're not quite where you think we are, but they will have all of the tools in place to say like, oh, well, actually, I think we're getting there much faster than you do, or than your indicator does, or whatever the inputs are that drive your leading indicator. I think a good sort of successful kind of sell side person is giving the reader that framework and how they think about the market, why they think about it that way, sort of what the drivers are, and then what are the market implications in different phases. But ultimately, it's one person's sort of opinion. Hopefully, it's robust and thoughtful, and marries both kind of quantitative work with some qualitative assessment of how how similar is today's environment that from environments of the past that make the framework relevant today. I mean, the other thing I'll say from a buy side perspective, reading sell side work, what I used to say to people is that for me, reading or engaging with the sell side was a little bit like reading the opinion page of the newspaper. And ultimately what happens is that, the opinion page of the newspaper, you're going to read columnists that you like, that share your worldview, have a similar framework to you, or at least have inputs that are similar to the inputs that you use. I mean, ultimately, I'm going to be more attracted to that person than I am going to be attracted to a person whose worldview or framework is just completely in a different realm than mine. Maybe they're right, but I personally have never found it that useful to sort of go and seek out the person who thinks differently than you. It's fine to find somebody who might have a different view than you do, but I think if they have just a completely different worldview and think that markets operate on a different spectrum than you do, I never found that useful. So, ultimately, when you have the op-ed of the newspaper, I mean, when you see your favorite columnist, writes an article, you're going to read it because you like the way that they think, and oftentimes they might be flagging things for you that are not yet center of your radar, or that what they're talking about is likely to be part of your framework. It just might not be something that you're engaged in today. So those are a couple of things that I think about. I'm happy to elaborate on anything I said.
Well, I think that's really what we're all hoping for as we engage in discussions with other market participants is those who give us things to think about. No one has anything close to a crystal ball. I mean, that's the first thing. Is prediction is not a business we ought to be in, but framework and trying to put things into terms where the probabilities may be favorable, I think is important. And that's where I wanted to turn to, is to uncover a little bit more about your own framework. You've described it as global macro through the lens of equities. And if we're to think about traditional global macro, it's really rates and FX. You might throw commodities in there. And so equities is not as much a stomping ground of global macro, at least traditionally. Maybe it's become more so. So if you can, start at the 30,000 foot level of how we should understand your framework, how you think about the profit cycle, distinguishing, let's say, the economy from the profit cycle. Talk to us about the framework.
Yeah. So first, I think you hit the nail on the head in the last point. I mean, I would say that, and this is a big part of my own framework, is trying to think probabilistically, right? It's hard to have the crystal ball to sort of know the precise outcome. And unfortunately, that's often the pressure that sort of a lot of people have. I mean, I'll use the, U.S. equity strategists who are kind of beaten to death about their year-end price target. I mean, it's kind of a ridiculous exercise, right? Like, I understand why it's done and why the street does it, but it's probably the least useful thing that they do, right? So as opposed to, to your point, sort of thinking probabilistically and having sort of a set of framework that sort of, hopefully helps to narrow the distribution of outcomes or how you're thinking about the market. Again, to your point, echoing kind of what I suggested, which is having parts of the market that you think are sort of most likely to do well under given sort of certain or a given set of circumstances. And look, in a nutshell, that's what I try to do in my own framework, which is very cyclical growth oriented. So when I say cyclical growth, I mean, you can kind of think of something like the ISM cycle. It doesn't have to be explicitly ISM, although that does a pretty good job of capturing the majority of what the cyclical growth cycle is all about. And really, ISM, in my opinion, is just a real-time measure of activity, which ultimately gives you a really good gauge and guide of where the profit cycle is headed in terms of its direction. And I think that this is probably a key element of my own framework, which is typically it's the rate of change and the direction of growth indicators that matters most for equity markets. And when I say equity markets, I'm sort of focused less on S&P 500 index level, and I'm thinking more about what are you doing? Like if you have an all equity portfolio, what parts of the market are you overweight, underweight, or what parts of the market are you long or you're short? And I think when you look at the growth cycle, the profit cycle, you can identify those parts of the market that are likely to have, again, back to what I said earlier, alpha headwinds and alpha tailwinds as a result of profit growth cycle. And I guess if I were to, why profit growth? I mean, I think of profit growth as representing sort of the oxygen for equity markets. When it's abundant, they can breathe freely, right? And everybody's growing. And so in an environment where everybody's growing, you're sort of incentivized to buy cheap the cheapest asset because there's sort of no real reason to differentiate on the part of growth if it's so abundant. The problem is when profit growth starts to slow, this, naturally, or is in short supply, it naturally starts to, kind of show that there's pockets of weakness, within the market. Now, some of those, areas they might also carry balance sheet leverage. There are other, factors that contribute to that weakness, but that's a big part of it. And so that cycle is really, again, back to what I said, I think benefits or is a driver what makes for good sort of sell side research, which is indicator-based framework, and then identifying in different regimes and different growth regimes which parts of the market do well. And when I say parts of the market, we're talking about geographies and sectors, style factors of varying type. They could be market-based style factors or sector neutral based style factors. You can obviously extend this into rates, FX, vol markets, shape of the curve, credit spreads. And so for each market, you can kind of apply the regimes or the growth regimes and understand which parts of the market do well. And then obviously you can kind of start to map, those markets to other markets. So to your point, you can see when you use different style factor pairs, for instance, the profitability factor versus the risk factor. In this case, risk being some combination of small, high beta, balance sheet leverage. That spread between those two factors tends to correlate extremely well with something like credit spreads. That makes perfect sense, right? I mean, highly profitable companies or quote unquote high quality companies that likely have a more stable earning stream and or sort of high margins are less likely to be part of the credit spread. They're less likely to have sensitivity to widening credit spreads where small, high beta balance sheet leverage would. But that's all part of the mapping. And so I think that, what you can do as you move through the cycle or, your indicator-based cycle, it helps you to see what parts of the market are, sort of more or less advanced in a given regime. That ultimately leads to trade construction, trade ideas and or trade construction and thinking about, what parts of the market offer the kind of the best bang for the buck, but also where there can be disagreement. Now, I guess I would say that one of the important parts of the framework or having a framework is there's an element of, history doesn't repeat, but it often rhymes. And so you're trusting that history is a strong gauge for kind of what will happen in the present and the future. It's not to say that good old fashioned fundamental analysis of the current environment is not also needed, right? You sort of have to evaluate what's happening today that might truly be different from the previous 50 years of time and decide whether that particular market is relevant in the framework today or is less relevant today, or maybe it's still relevant, but you're sort of less confident in how that market will react to your sort of growth regime today as a function of a different set of characteristics. I'll use one really quick example for that, but sort of energy circa 2015 through 2018 was a good example because typically that would be viewed as a late cycle sector. But because of what was happening in shale and sort of OPEC and oil prices at that time, that was a very poor way to express a late cycle view in markets, meaning energy massively underperformed what you would have expected at that stage of the growth regime as a function of its current fundamental characteristics.
When you look back and you think about the macro regime, whether they're tailwinds or headwinds, and you think about sector or style favorability or unfavorability, what are some examples where there was a specific macro factor that was driving this, allocation decision for you, where you felt like one of the sectors or styles was just, underappreciated relative to whether it was the narrative in place or this set of macro factors that you thought was supposed to be driving the price? What's a historical example of where there was a divergence?
Well, I guess one example would be, if I understand your question the right way, let's call it 2017, through 2018, really through 2019 period, where I think the macro message from markets was one of sort of growth scarcity, right? Sort of generally weak nominal growth environment. Obviously we had periods where you had, kind of flashes of growth, but they were, with like around, kind of Trump driven, tax cut and whatnot. But in the background, was one of generally sort of weaker, growth scarcity and weaker growth. I mean, I would say that was a big driver around, I'll call it sort of NASDAQ outperformance, which coincided with, flatter yield curves, generally lower or stable and lower rates, both nominal and real, generally benign sort of inflation environment, a policy backdrop that was on the easy side or, had an easing bias. And I think that was, a pretty frustrating period of time for a lot of people because it sort of felt like bubbly, right? Or it felt too persistent. And there was a disconnect between, kind of generally, quote unquote, sort of weak or weakish or sluggish economy, yet a pretty strong equity market environment. That strong equity market environment was really, kind of driven by a few or a subset of the market rather than the whole market when you look beneath the surface. But I wouldn't say that was fundamentally inconsistent if you think about what the macro drivers were from the time, but it sort of made the broad equity market look disconnected from reality, even though I think it was reasonably well explained by the set of macro conditions.
And I'd love to run with that because we, of course, had the COVID shock, which was a huge market shock, lots of Fed backstopping and a massive fiscal response as well. And then this just giant outperformance of those tech stocks, the top end of the triple Q doing incredibly well. So I'd love to get you to talk about when you look back at that period, there's a number of things going on. Number one, even as the economy is struggling and people may have lost their jobs, the government is fortifying incomes with its fiscal response. And so people are home. So people might be jobless, but in some ways cash rich. And you also have these incredibly low rates and this, at least the early days of COVID, a massive inflation shortfall, at least for a short period of time, and very, very low rates. So how should we think about the initial massive outperformance of those growthy stocks in light of, both what was a very low rate period, low inflation period, and then, of course, subsequently, a lot of it's come home to roost. How do you think about that?
Yeah, look, I mean, up front, I would say that in my mind, COVID was more of an event rather than a recession. I mean, of course, the consequence of policy decisions made at the time resulted in a recession, but it was sort of so short and sharp that it was a very different style recession. And that's why it was a little bit more akin to like a natural disaster or a hurricane that hit. And then, the backside of that hurricane was everybody cashing in their sort of insurance premium, right? And that was the stimulus government response to that, which was, oh no, stay home and kind of rebuild your house, after a nasty hurricane, as opposed to, and so it was a little bit, so I do think that particular event was important in its style. The other thing I would say is, I think that what happened is that the COVID event really exacerbated a lot of the trends that were already, kind of in place. And so it was almost like an accelerant to quote unquote digitization, right? Or the idea of doing more in a digital way, whether that's e-commerce, which obviously is a big part of it, or, kind of the mobility aspect of, working from home, or, a lot of the tools and software tools and things were kind of already there, but there was no really good reason to force anybody to use them, right? And so everybody kind of went on with like sort of normal course of business because that's what you've done for the previous 10, 20, 30 years. And there was no reason to change that. COVID came along and kind of changed that. I mean, actually, in some ways, when you think about it, I mean, and to kind of be a little bit more positive about it, I mean, I think it was the fact that we had technology in place that allowed the world in business to kind of continue to operate despite being shut down for whatever it was, a few weeks or longer, was, I think in hindsight, is pretty impressive. Obviously, not everything worked, perfectly, but on the whole, things stayed connected. It didn't, in theory, could have been more disruptive. But I guess that part of the COVID aspect, there's a little bit of it's almost like Y2K, which, some of the people in the market have made the analog, and I guess I'm sympathetic to that, which was, an event happened which resulted in a massive pull forward in demand, things that were likely to happen over the course of the next 2 or 3 years anyway, but instead of happening over 2 or 3 years, they basically happened in 2 or 3 months. And it just results in this massive pull forward of demand and kind of making that switch from an analog portion of your business model to a digital portion of your business model. Or if you were a local provider of some service, whether it's a restaurant or otherwise, you very quickly made the move where possible to offer takeout or delivery or your service in a different form, which kind of exacerbate a lot of these online trends. So I think that, I don't know, that's kind of how I think about it. I mean, I think you have to kind of couple that with an environment that was, at the tail end of a, long easing cycle. And so now we have sort of easing on steroids. I mean, 30-year real rates were what, like minus 50 basis points? I mean, if 30-year real rates are minus 50 basis points, or triple B corporate credit all in is yielding you 1 or 1.5%, then what do you think an equity or a company that's growing revenues, 10 to 15% a year, has free cash flow margins, north of 20%, what is it worth? I mean, it's worth more. I mean, a lot more. So I think just like we've seen in other parts of the market, lower discount rate kind of just resulted in a step function higher, valuation across assets. And naturally, the higher quality, well-run, strong growth assets commanded a higher valuation multiple than some of the weaker parts, even though the weaker parts also benefited from that tailwind.
We'll talk more about the kind of interplay between rates, inflation, and equity valuations. I want to just uncover your risk kind of mosaic a little bit further. And you'd said to me once that one of your favorite quotes is from Stan Druckenmiller. He says, "The best economist I know is the guts of the stock market." Talk to us a little bit more about that insofar as your own internal measures of risk, both on an absolute basis, sometimes on a relative basis. I've seen you create certain ratios that you feel are informative. What are some of the things that you think are really relevant at this point in time?
Sure. No, I mean, Stan is obviously a legend. So, I mean, I think there's probably more than just one quote from him that deserves attention, but that one sticks with me because it's a big part of how I view markets. I mean, obviously, in any indicator-based framework, you have an opinion, or your framework or your model has an opinion of where you think things are headed. Using the guts of the stock market is a real-time gauge in my mind of whether your model or framework is on the right track or not, right? I mean, and that's just the way of doing it. I mean, I think what's important about it is, look, everybody sees S&P 500 price or NASDAQ or Dow Jones or whatever the sort of index of choice is. I think the real message from markets is often what's happening internally. And that's obviously the genesis of Stan's comment. When you see cyclicals versus defensives performing poorly, despite an equity market that's doing well, in my mind, that's a pretty clear sign that there's a kind of a quote unquote cyclical growth problem. Now, it could take a while before it shows up at the index level. One of the things, and I'm pretty sure you and I have talked about this in the past. I mean, I often think that if we use the baseball analogy, typically the first 5 or 6 innings, of any correction or kind of cycle correction, most of what's happening is happening internally in the market, in different pair trades, style factors, things of that nature. It's a preference that investors have, and that they want to shield themselves from various sources of unwanted volatility that don't necessarily make them short the market, but make them sort of implicitly short the market, or if you can think of that way, or implicitly have a lower beta to the market. And oftentimes, by the time the S&P 500 corrects in a meaningful way, 10, 15, 20%, that's often the sign that you're at the later stages of that correction, not the early stages of it. Now, it's not always true, and it depends on how long the cycle is, but that's typically how I think about markets. And so cyclicals, defensives is an easy one. I think most people understand that, and it's in textbooks, and so it's not too controversial. Not as controversial as something like different style factor pairs that might have some of the same attributes. But I think cyclicals, defensives is a pretty good way of saying, irrespective of whatever your GDP opinion is, that doesn't necessarily apply to markets, and then naturally cyclicals, defensives ratio or things like that can move in such a way or diverge far enough away that source of internal weakness, if that's the right way to think about it, kind of creates that fragility that you talked about before. And then ultimately, when you have a fragile situation, that's just more vulnerable to, to some shock, whether that shock is, commodity price volatility or, credit spread volatility or some other source of issue, or just, again, like a hiccup in economic activity. That vulnerability then can kind of leave the market in a more vulnerable stance, and kind of naturally then you sort of result in a headline index level correction or something along those lines. In a nutshell, to me, the internals of the market really just represent what is the average investor, or you can think of it like generalist investors, risk tolerance. And if their risk tolerance is fading, or they're less willing to buy, high beta or leveraged cyclicals, then they likely see something. I mean, equity investors are greedy, right? So if there was a good reason to make money off of these sectors, then collectively they would likely do it. That's kind of the way I think about it. And so if they're shying away from those groups, then there's probably a reason that they're shying away. And I think that typically deserves attention.
Yeah, and I think it's really worth considering that once that rotation has occurred, so the first rotation is just not out of the market, but just across the market into something that might be a little bit more welcoming. And when that rotation ceases to work, that's, I think, when there's some reexamination. I certainly think of that in the pre-GFC period where crude was, at 145 in the summer of 2008. Certain defensives held up really well into 2008, and then ultimately gave way. And then this most recent period, if you think certainly about energy stocks as well off their highs as well. Are there any other just indicators that you find have good forward-looking information content that you can share that are on your dashboard?
Yeah, so I think a lot of them tend to be market-based. I would say cyclicals defensives is a standard one. One of my, kind of favorite broad measures of activity is to use the CRB raw industrial materials index, which is basically a basket of commodities, spot prices, and the commodities that are in the basket are somewhat untraditional. So they're not commodities that are, they're not widely traded on financial exchanges. So it's sort of less prone to financial market speculation, but it includes things like burlap, tallow, resin, tin, right? So like stuff that's used to make stuff. And I guess and it also has the benefit of having like 60 years of history, which is nice. The way I think about it is that most of these commodities, and because you're using spot prices, they're not necessarily in short supply, like the way that we think about oil or people think about copper, and that their supply is relatively sort of fixed in that sense is kind of always the case. So then most of the price movement is a function of demand, and that if activity or the burlap dealer is getting less calls for burlap, then burlap prices, probably start to go down, right? And so when you look at something like that, index, you can find that typically has, again, particularly when you evaluate it like on a momentum basis, like year-over-year changes, you can see really strong correlations with things like, China credit impulse and other PMI measures. To me, like what you're trying to do in markets is triangulate the message from different markets that have a different vantage point to help strengthen or increase your confidence, the message coming from your other more traditional growth indicators. And so that's another input. And then on the style factor front, this is an area of the market that I think has been around for a long time. Obviously, I'm a French. It has grown up a lot in the last decade, in my opinion, and has become a much more sort of offensive part of the toolkit for investors, particularly I think in the hedge fund space, or what I would say is the more discretionary, fundamentally oriented hedge fund space. I think that group has certainly got up to speed about what style factors are all about. And I think there are a number of things there that you can use. So for instance, I like to look at sector neutral low risk, or if you want to think of like sector neutral anti-beta, or that's where basically in each sector you're long the lowest beta stocks and you're short the highest beta stocks, but on a sector neutral basis. So you're sort of really reducing the tech versus utilities kind of dilemma. That I have found to be pretty useful, pretty similar to cyclicals versus defenses, right? It's working off of the same attributes and factors, but it maps really well to things like financial conditions tightening, It can map to things like the VIX or credit spreads naturally, right? Because these things are all, there's a lot of, co-integration. And you can see other versions of that if you were to look at something like, I like to use, long consumer staples versus short Russell 2000 as another way of basically playing beta within the market. Kind of something that's on the low beta, spectrum versus something that's on the high beta spectrum. And there's also a lot of, one's defensive, one's cyclical. One tends to be sort of mega cap brand name, best of breed companies, and the other tends to be, a bunch of small companies that have not yet made it or maybe will never make it. And when you pair those two things, you're a vol guy, but I would say that's a great way of basically having sort of long vol or, kind of having convexity in your portfolio that's not necessarily negative carry, right? I mean, obviously one of the challenges with buying vol is you have to deal with the shape of the curve and other features. But some of these paired trades, I mean, of course, they'll never have the same features or convexity as VIX, but they can have a very similar profile, but they allow you to kind of stay in them longer or build your portfolio around them while you wait for the time to sort of act on something like VIX. And then, the last one, which is similar, is sector neutral quality, which kind of encompasses a lot of those things. High quality tends to also be low beta, tends to also have high profitability, and low quality tends to have, more leverage, small cap, higher beta, more cyclicality. And so that kind of is another one that I've shared with people publicly and is a tool in the toolkit.
Yeah, I think that's a really interesting area of exploration, which is using portfolio construction. Is there a way of effectively renting some long vol without necessarily paying explicit carry? And of course, we know you can't do that on a guaranteed basis. I mean, that was crisis alpha, as they call it in the allocators business, was really about owning duration as a hedge. And we know that really came undone this year. So you can't guarantee it, but there are certain areas of research. One would be, again, momentum as a style factor tends to do some of that. I think it's a really interesting area. And, there's another area that just in terms of portfolio construction, this is where I wanted to spend the rest of our time, is just on this incredible new thing called inflation and how different, whether they're sectors or style factors, interact with the factor of inflation. One of the things as we talked about before doing this podcast, we talked about just how the market's interacting with inflation, with Fed policy uncertainty. And you made the point that the market's kind of shifting from the risk of too many Fed hikes to growth cuts. The way I've framed that as someone focused on options and volatility is that in some ways the equity market is short the straddle on rates. Rates up too much, no good. Rates down too much, that's the result of something that's no good. That's the growth cuts side. And boy, this yield curve is a fascinating thing to look at in terms of how it continues to imply speedy hikes, but then out next year, a number of cuts. It's might not be completely unprecedented, but it's a rare thing to see. And maybe it's consistent with what you said, is that we had to pull so many things forward that you're going to eventually almost probably overdo it. Maybe that's what the market's saying. So I'd love for you to frame that as we round out the conversation, how you're thinking about portfolio construction in this environment of epic inflation and thus Fed policy uncertainty. How should we be thinking about that?
Yeah, no, I mean, there's a lot to unpack there. I mean, I think first, one point I want to elaborate on a little bit with the cyclicals versus defensives ratio and some of the points that you just made around rates and inflation. I mean, I think that this is really important and interesting, kind of way to use cross asset markets, right? So typically and historically, if you were to look at nominal yields higher, meaning 10-year yields are moving up, you would often find that cyclicals are outperforming defensives because that move is more often than not a result of growth acceleration, which also, or reflation, probably also includes rising inflation, as inflation, typically follows growth. But that's one of the important things that was happening in the last year that I was quite focused on and vocal about, in that the move higher in rates had very little to do with higher growth or reflation, and it was sort of the bad kind of rate rise, which was unlike what we saw in 20 the tail end of 2020 or even in the first part of 2021. But again, that's how you use cross asset markets in order to kind of evaluate and judge whether something is quote unquote good or bad, and also how you want to think about portfolio construction. I think that this is the part where you sort of have to, kind of have some, imagination, and you take some creative liberty with what you're doing, because this cycle there's aspects of this cycle that are similar to other cycles, but there's also aspects that are actually quite different and or new and somewhat untested. And so, I'll tell you what I think, but I mean, I would also say there's pretty wide distribution of potential outcomes, as a result. I think that the stimulus response to COVID resulted in a little bit of like a cash for clunkers type program. Massive stimulus, which incentivized buying. Like you said, I mean, people maybe didn't have a job, but they were cash rich and they were at home and they needed to do something. In a weird way, at the same time, authorities were not allowing people to work, i.e. produce, or to make enough of, what we needed or what was being demanded. So that obviously, creates a pretty nasty sort of inflation situation. And this all coincides at a time when the Fed, somewhat by chance, obviously not foreseeing the COVID event, said that they were going to purposely let it run hot, or they were going to have this average inflation targeting policy to make up for a decade of missing their target by whatever it was, like 25 basis points, which is kind of ridiculous when you think about it, but whatever. So these events all kind of came. My base case or sort of working assumption is that we basically have a kind of what I would call boom bust style economy, somewhat akin to what happened in the 60s, 70s, and 80s. And it's just something that we haven't experienced in a long period of time. I think driven by stimulus, which drove too much demand, which resulted in overproduction, which resulted in companies sort of mismanaging their inventory, right? Either double ordering or ordering for a growth rate or environment that was unlikely to be sustained. And now you're unwinding that, which will, I think, in my opinion, will sort of result in some pretty meaningful sort of disinflationary forces on the other side. Now, disinflationary forces in some areas more than others, meaning like consumer goods, I think there'll probably be a lot of disinflation, not necessarily disinflation in things that are sort of undersupplied, whether they in different parts of the food chain. But that's I think that's a slightly separate point in terms of globalization, sort of some of the unwinding of that and diversification of supply chains. Some of those things were underway before COVID and will kind of continue, and maybe COVID sort of just exacerbated or sped up some of what was going to happen there anyway. But the point, I guess my point is, I think that as growth, and you made the point about from Fed hikes to growth cuts. I think as growth weakens and we're on the backside of the cash or clunkers program, that we'll see prices and the rate of change in prices come off pretty quickly. So what I'm focused on right now is not whether inflation ultimately falls below the Fed's 2% target. I think that that's a trade and a decision to make for another day. I'm focused more on inflation. Let's say core inflation is at 6.5%, and as it moves to 5%, to 4%, to 3%, how the market narrative will change and the perception of the market will change. And I think what will happen is probably pretty similar to what happened in the last, and what typically happens, which is collectively, or in some pockets more than others, we'll extrapolate that move to assuming that we slipped back into kind of a pre-COVID regime. And that may or may not be the case, but the way I think about that in a portfolio sense is that as that happens, the market will assume that the Fed will cut rates. I think the market will assume that certain styles and parts of the market will come back into favor as a result of we move back into a quote unquote low rate environment and low rate regime. Now, ultimately, if we trough at 3% core inflation and a new cycle starts and we start to accelerate from there, then a lot of the trades that I think have worked really well over the last year can work again. But I think that there's this interim period where that narrative changes and the focus shifts, more towards the consequences of significant financial conditions tightening and the growth impacts of that. And then the inflation impacts of what happened post-COVID, they probably don't go away, but they might not be the front and center focal point because growth takes the focal point. And then the assumption is that inflation typically follows growth and will come off. And even and I've shared this publicly, but I think even in the 1970s scenarios that people used to analog the current environment, that was also the case. When you had recessions in the 1970s, year over year, rates of inflation came down. And during those periods when inflation was coming down, bond yields fell and the stock market did well, because that was the primary factor and the primary risk. And one of the things that I kind of find challenging in having this conversation in the public market is, people will often say, well, in the 70s, bonds were a disaster or the stock market was a disaster. That's true if you can actually hold that portfolio for a decade and don't have to worry about mark to market and don't touch it. But in between, you had 35% corrections in the 70s, followed by 65 to 70% rallies, S&P 500, and obviously had pretty big moves in rates as well. I'm not sure that most people will be able to sit around and stomach those types of moves that can happen over the course of 12 to 18 months, even if their 10-year view is right.
Well, last thing I want to touch on is just your presence on Twitter and your authorship in the Substack space. Tell us a little bit about what you're accomplishing there. Your efforts are resonating and you've gathered a lot of traction there, but tell us about what you're publishing and how do people find you?
Yeah, sure. So you kind of started this, you opened with this at the outset. I think that what I'm writing about is a combination or a little bit of a blend of what you might see from the sell side and or what you might see from the buy side, or somebody who kind of has straddled both those universes. And that's really just a function of me communicating and sharing what I'm doing with my own personal capital, or how I view markets. It's a sort of open forum, and social media is one of those things that allows you to, I guess there's pros and cons to it, but reach a pretty wide audience. And for me, it's helpful selfishly to kind of, the feedback mechanism and the interaction that comes from those discussions. And hopefully, people find the work insightful and interesting and unique or different from what they're currently digesting. And that obviously helps to, feed further the interaction and feedback. In terms of where to find me, it's at Mr. Blonde _macro on Twitter is the sort of the easy thing to do. Twitter's really become, I think a pretty big force in terms of, how people digest, financial market information or, kind of news and the news flow. And, I use that as more of a conversational, type tool, or a big, kind of chat room. The more meatier, thoughtful stuff is at Substack, where, I try to, kind of have a more complete thought, as well as share some of the data analytics and indicators that I use to drive my, my framework, and then, make some observations about parts of the market that are interesting to me, whether they be pair trades or, other structures. But it's Stuck in the Middle is the name of the Substack.
Fantastic. Well, I'm glad we got a chance to do this, and thanks so much for spending the time.
Yeah, that's great, Dean. I really appreciate it. I told you before, I'm flattered to have been invited to your podcast. It's one of my regular, on the regular list of listening for me. So it's been great. Thanks a lot for having me.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.